Today we are going to discuss IIBF Certified Credit Professional Examination Memory Based Question which happened on 22nd November 2025. So already I have created videos of previous year. If you want to get those videos, please check the description section of this particular video. You will get the link and we will see what type of question appear in this examination and what are the possible answers, and you can see what are the important topics from where question are being appearing every time. So this will help you to gauge the topic, to know the important topic and see how much your level of preparation. Try this MCQ session as a mock test. Give it like a mock test. See the question, pause the video, try it yourself and then see the explanation. So let's get started with our first question. The first question, as you can see, that under the priority sector lending norm for housing loan, you're talking about housing loan, right? For housing loan, which of the following correctly matches the population of the center with the maximum loan amount and the dwelling unit cost? So 4 options have been given. Option number A, population over 5 million, loan limit is 50 lakh, dwelling unit cost 63 lakh. Option B, population more than 1 million up to 5 million, loan limit 45 lakh, dwelling unit cost 57 lakh. Option C, population less than 10 lakh, loan limit 35 lakh, and a dwelling unit cost 44 lakh. Options they have given A and B, B and C, A, B and C, and A and C. So now tell me, which option do you think is correct? So it is a very good question. First of all, let's see the core idea. Bank have a special rule for giving housing loan under priority sector lending. And the loan limit and the house cost depends on the population of the city as well as the town. So there are 3 categories to remember. The first category we have is the big cities, right? So big city with population more than 5 million. So in the case of big cities, having population more than 5 million, loan limit is how much? Loan limit is 50 lakh. House cost is how much? House cost is 63 lakh. If it is a medium city means population lying between 1 million to 5 million, right? So if it is a medium city, then the loan limit under priority sector lending is how much? This has been revised. Earlier it was different. Loan limit is 45 lakh and house cost is 57 lakh. And if it is a small city means population less than 10 lakh, right? So in that case, loan limit is 35 lakh and house cost is 44 lakh, right? So all these, now let's look at this option number A. Option number A is correct. Population more than 2 to 5 lakh, right? That 5 million, that is big cities. Loan limit is 50 lakh, dwelling unit is 63 lakh, correct. This is the correct answer. Option number B, yes, population more than 1 million up to 5 million. So lying between 1 to 5 million, right? So loan is 45 lakh and dwelling unit is 57 lakh. This is also correct, right? Option C, less than 10 lakh. So it is a small, loan limit 35 lakh and dwelling cost 44 lakh. So I can see that all the 3 options are correct. A, B and C are correct. So the correct answer is all A and B, A, B and C. So please note it down. I will update in the CCP study material also. I've just updated it. So this is the new lending limit as per the RBI. RBI has revised it on from the 1st April 2025. So please note down this limit. This will help you in the upcoming examination. Friends, if you are looking for 8 to 9 previous year such kind of PDF, you can enroll in our CCP courses, certification course, detail regarding which you can WhatsApp me on this particular number to get more detail. And in this course you will get unit-wise theory, unit-wise MCQs along with previous year question paper as well as capsule course content. Many aspirants have cracked the paper in their very first attempt using the material, and it is completely updated one as per the revised guidelines, revised updation provided by the RBI. Now have a look at the next question. Question number 2. So just remember, okay, one way to remember, let me give you a trick to remember it. So whenever you think of big, just remember 50, right? Just remember what big means 50. Whenever you think of medium, just think of 45. And whenever you think of small, just think of 35, right? And just add 13. 50 plus 13, 63. 45 plus 12, 57, right? And 35 plus 9, 44. This way you can remember. So 13, 12 and 9, right? 13 to the loan amount, 13, 12 and roughly 10 to 13 for the house cost. So 15, 45 and 35. Big 15, medium 45, small 35. This way you can remember. And 10 to the big 50, you just add 13. To the medium, you add 12. To the small, you add 9. And you will get the, what? You will get lakh house cost, right? I hope this will help you. Please hit the like button if you really think that this trick was really helpful. Now let's look at the question number 2. Question number 2 asks you, that it's all about, stamp duty under the Indian Stamp Act. So what is the big picture, basically under the Indian Stamp Act, which of the following statement is correct regarding non-judicial stamp and adhesive stamp in the context of credit and security documentation? Which of the following is correct? So it is asking you, we have to find the correct one, right? Clearly written. Now let's look at the option. So options they have given: non-judicial stamp are used to pay stamp duty on document like loan agreement, hypothecation deeds, and mortgage deeds executed outside the courts. Option number B says, that adhesive stamp are affixed on central instrument such as bill of exchange, promissory note, and receipt to denote payment of stamp duty. Option number C, they say that a negotiable instrument bearing adhesive stamp of the proper amount duly cancelled is considered duly stamped under the Act. Option they have given A and B, B and C, A, B and C, A and C. Which option do you think is correct? So this is a very good question. Let's try to answer this one. So what is the big picture here? Whenever you create document like, loan agreement, mortgage deed, promissory note, you need to pay stamp duty, right? So whenever you need to create loan agreement and mortgage deed or promissory note, what you need to pay? You need to pay what? You need to pay stamp duty. Okay. So this is a proof that document is valid, legally valid. So there are two main kind of stamp that you should know. The first is called, adhesive stamp. Second is called non-judicial stamp. So what is the non-judicial stamp? Non-judicial stamp, these are, which includes, e-stamping also. E-stamp is also a type of non-judicial stamp. So they are used for document executed outside the court. Yes, it is correct. They are for document executed outside the court, like, loan agreement, like, hypothecation deeds, or, mortgage deeds. But if you don't use them properly, your document may become invalid or inadmissible until you pay penalty. Right? You have to pay penalty there if you don't execute them properly. So we are talking to the context of, non-judicial stamp. Second kind of stamp we have is called adhesive stamp. What is adhesive stamp? These are gummed stamp stuck on the instrument like bill of exchange, promissory note, receipt, share transfer. They show that stamp duty is paid for this specific instrument. And negotiable instrument to the context of adhesive stamp. If the adhesive stamp is of the correct amount and cancelled properly, the instrument is considered duly stamped under the Act. So two things are there. First of all, it should be adhesive stamp. It should be of the correct amount. Correct amount should be written. And in addition to the correct amount, it should be properly cancelled. Cancelled properly. If these two things are there, then they are considered, duly stamped under the Act. Now let's look at this particular question. What do you think about option number A? So option number A is perfectly correct. What about option number B? It says that they are affixed on, yes, correct. Option number C, a negotiable instrument bearing adhesive stamp of the proper amount is considered duly stamped. This is also correct. So we can see both, all the A, B and C are correct. So option number 3 is correct. So one way to remember it, let me tell you that whenever you see this word quote out, think of non-judicial stamp. Quote out, you can think of non-judicial stamp, right? Non-judicial stamp paper. And if we talk about the small instrument, you can think of the adhesive stamp. A small instrument, you can think of adhesive stamp, right? Right. And big document need big paper. A small document means a small sticker. This way you can remember. Okay. So big document like, loan agreement, they need a stamp paper. And a small instrument like bill, they need adhesive stamp. So remember, non-judicial stamp paper, loan agreement, mortgages and guarantee. And adhesive stamp, they are affixed on bill of exchange, promissory note and receipt. I hope this makes the sense. Now have a look at the next question. The next question is on your screen. It says that, as per the RBI prudential norm on income recognition and asset classification, which of the following is true regarding a stock audit requirement? Yes, this question pertains to, a stock audit. It's all about, stock audit requirement. Very good question. So, basically options they have given that non-performing advance account with outstanding exposure of 5 crore and above. So you have to tell which is true. So non-performing advance NPA account with outstanding exposure of 5 crore and above must undergo a stock audit at least once a year by external agency. B says many banks extend this requirement through internal policy to all the large working capital account, often starting from 1 to 5 crore upward. Option C say a stock audit is primarily used to verify the value and availability of the primary security such as a stock and receivable. Now tell me which option is correct. Option they have given A and B, B and C, A, B and C, A and C. Account turns into NPA, right? Non-performing asset. And exposure is 5 crore or more. So RBI says that you should do a stock audit. RBI says that you should do a stock audit at least once a year. You have to do a stock audit at least once a year. right, by an external agency approved by the board. So what do you think about option A? Perfectly correct. Yes, this is exactly what option number A is saying. You have to do external audit by an external agency approved by the board. Now, what about the bank internal policy? Yes, you know, many banks go beyond the RBI rule. They apply stock audit to large working capital account, often starting from 1 to 5 crore. Yes, this is also correct. Why? The main reason is, you know, the main reason behind point B is the risk management, right? Risk management. Now, what is the purpose of the stock audit? So basically, you know, to check the value, to check the availability of the primary security like stock and receivable, right? So B is correct. What about C? Primarily used to verify the value and availability of the primary stock. Correct. So we can see that, you know, all the three statement A, B, and C are correct. So the correct answer will be option number 3. Right. So you can think of this. You can think of it like this. So if it is a 5 crore, if it is a 5 exposure is 5 crore, RBI say do audit. RBI say you should do audit. If it is 1 crore, then bank say better safe. Bank say better safe. And remember, a stock audit, what we check? We check stock and we also check receivable. We check stock and we check the receivable, right? So just remember, RBI mandate annual stock audit for NPA more than equal to 5 crore, and bank often extend it to big account like 1 to 5 crore for risk management purpose. Now friends, have a look at the next question. Very good question related to ECB. So this question is about, you know, external commercial borrowing and the famous 7:1, you know, liability equity ratio. So the question is, under you know, RBI ECB framework, what does the liability equity ratio of 7:1 signify for borrowing under the automatic route? Yes, you know, there is a liability equity ratio that corresponds to 7:1. What does it signify? Option A says that, you know, it is calculated as total outstanding ECB from the concerned foreign equity holder divided by the equity contributed by that holder. Option B say the ratio apply only when. Option C say that if a foreign shareholder has an equity of $10 million, the maximum permissible ECB under automatic route is normally up to $70 million outstanding from that shareholder. So you have to answer which of the option is correct, right? Obviously it is regarding correct one, right? So of option they have given A and B, B and C, A, B and C, A and C. Means all kinds of permutation and combination they have done. Now, what is the big picture here? You know, Indian company can borrow money from foreign lender. I think you know it very well. That's the role of ECB. Suppose this is a foreign lender. This is a foreign lender and this is an Indian company. So Indian company, this particular company, they can borrow from foreign lender under the RBI ECB rule. So when the lender is a foreign shareholder, RBI say that keep a balance between the loan and equity, right? So loan is a kind of liability. So that should be kept. There should be balance should be kept between loan and equity. And what that balance should be 7:1. If you have taken 7 crore loan, then 1 crore should be equity. Now what is this ratio? It is calculated, you know, total ECB outstanding from that foreign shareholder divided by equity, right? Contributed by that shareholder. Very, very important. See, equity, basically what is the numerator? It says how much ECB, external commercial borrowing, outstanding from that foreign shareholder. Okay. And in the denominator, you write, you know, equity contributed by that shareholder. How much equity they have contributed? Obviously, if there is a shareholder, obviously they have contributed some equity. Now, equity includes paid up capital, eligible reserve, share premium in foreign currency. Now, when does it apply? It only apply if the total ECB outstanding from a shareholder is more than 5 million. Please remember it. Very, very important limit I'm telling you. If it is exceed 5 million, right, then only it apply. Below 5 million, no ratio cap is there. Suppose, let me give you one example. Suppose a foreign shareholder has $10 million equity. Suppose a foreign shareholder, he has $10 million equity. Maximum ECB external commercial borrowing allowed is how much? That is nothing but $70 million. How come $70 million? 10 multiplied by 7, that is 70. If you borrow more than this, you need approval route. Right. So the under automatic route, it is more than, it is only 7:1. Right. So if you 10 million equity they have for a foreign shareholder, so they can borrow maximum $70 million. That's it. So you can think of 7 soldier guard 1/4. You can think of it like this. 7 soldiers are there and they are guarding 1/4. Right. So that is means, you know, 7 part loan for 1 part equity. For 1 part equity, you have 7 part loan. And remember, cap apply only after crossing the $5 million. This is a very important thing. If it is below $5 million, no cap will apply. Right. So remember, ratio is how to remember the ratio? So what is ratio? Ratio means how much external commercial borrowing done upon equity, right? And apply only if this ratio will apply only if ECB is more than $5 million. So what is the correct answer to this question? Let's come back. So option number is total outstanding ECB from the concerned foreign equity holder divided by equity contributed by that holder. Correct. B, ratio apply only when total ECB outstanding from a foreign shareholder exceed 5 million. Correct. If a foreign shareholder has equity of 10 million, the maximum permissible ECB under automatic route is normally up to 17 million outstanding. Correct. So we can see A, B. Friends, now let's see the next question that we have. The question is about the negative lien, right? So which of the following statement is about a negative lien is context of the bank credit is correct? Option A, negative lien is a borrower written undertaking that a specified asset will not be sold or charged to any other lender without the bank prior consent. B, it does not create a pledge, mortgage or hypothecation and the bank has no automatic right to sell the asset. C, negative lien is treated like a contractual negative covenant offering weaker security comfort than a registered charge and is usually considered additional comfort rather than primary collateral. So options they have given A and B, B and C, A, B and C and A and C. Which option do you think is correct about negative lien? So what is the big picture here? Whenever a bank give loan, let me explain. Suppose this is the bank, right, and it give loan to an individual. Okay, so whenever a bank give loan, they want some security, right? They want what? They want some security. So sometimes what happens, instead of taking a formal charge like mortgage, sometimes bank don't take formal charge. Or suppose bank instead of taking mortgage formal charge like pledge, they take a negative lien. What bank take? They take negative lien as security. So what is negative lien? It is basically a promise by the borrower. Remember, this negative lien, this negative lien is a promise by the borrower. This is a promise by the borrower, right? So now let's look at the statement. So basically, negative lien is a written undertaking by the borrower, and borrower says that I will not sell or give this asset to any other lender without your consent. So the bank get a moral and contractual assurance. So borrower promised that I will not send this particular asset without your consent, right? So what it is not, it does not create a pledge, it does not create a mortgage, it does not create a hypothecation, right? Bank has no automatic right to sell the asset. If the borrower break the promise, the bank can go to the court. What about the secure? So let's look at the option. Option A say negative lien is a borrower written undertaking that is specified asset will not be sold or charged. Correct. It does not create a pledge, mortgage or hypothecation. Yes, correct. It is treated like a contractual negative covenant offering weaker section comfort than a registered charge. So it is a negative covenant, right? Yes, it is a negative covenant, not a strong security. So it is treated like an additional comfort, not primarily collateral. It never treated like a primary collateral. So basically option number D is talking about negative covenant. This is also correct. So we can see that all the options are correct. Correct answer is option number 3. A, B and C all are correct. So how we can remember it? Let me explain. So you can think of negative lien like no lien. Negative means no lien, just a promise. There is a no lien, rather just a promise, right? Or you can also remember it like this: promise, not possession. Just promise, no possession, right? So borrower promise not to sell, not to charge the asset without consent, no pledge, no mortgage or automatic sale right. It is extra comfort, not the main security, right? That is called the negative lien. Now have a look at the next one. This question is pertains to invoice factoring. Which of the following statement about invoice factoring is correct? So you have to identify the correct one. Options they have given: factoring involves sale of trade receivable by a business to a factor at a discount with the factor taking over the collection from the buyer. B says Factory Regulation Act 2011 defined factoring as an acquisition of receivable by assignment or collection or financing. C says assignment of receivable in favor of factor must be filed with central registry under SARFAESI. Options they have given A and B, B and C, A, B and C, A and C. Which option do you think is correct? So you know it very well that business often sell goods on credit, right? So business often sell goods on credit. So that means they wait for customer to pay. But what if they need cash flow? Yes, obviously business then they sell goods for credit. But suppose they need the cash flow right now. So then comes factoring into consideration. They take factoring into consideration. It is a smart way to convert invoice into instant money. So you have invoice. If you want to convert this invoice into instant money, you can take the help of factoring. So factoring, you know what happened? The business sell its trade receivable or invoice to a factor, which can be bank, which can be NBFC, which can be monitoring company. So that is all about factoring. So who can be factor? Factor can be bank, factor can be NBFC, or factor can be factoring company, right? And the factor then collect money from the buyer, right? When the due date comes, and the seller get quick cash, and the factor take the collection risk. If you look at the legal framework, so legal framework is the Factoring Regulation Act 2011. So factoring means acquiring receivable by assignment for collection or financing. Only bank and NBFC registered at factor with RBI can do this as a principal business. And this TRDS platform you might have heard about. This TRDS platform also operate under this framework. And compliance, if you talk about the compliance, so whenever receivable are assigned to a factor, it must be registered with central registry under the SARFAC. So option number A says that it involves the sale of trade receivable by a business to a factor at a discount while the factor take over the collection from the buyer, correct? The Factoring Regulation Act 2011 defined factoring as an acquisition or receivable by assignment, correct? Assignment of receivable in favor of the factor must be filed with central registry under SARFAC, correct? So all ABC are correct. Option number 3 is correct, right? So remember the 3C. So whenever you see this term factor, just remember this keyword: fast cash from future payment. So payment that you will receive in future, and you are getting fast cash. That is how you can remember it. Fast cash from future payment, right? So remember the 3 C's. Three C is like 3C. 3C means cash now. Cash now means sell the receivable, right? Then second C stand for compliance. Compliance means registered assignment. And the third C stand for certified factor only, which can be bank or NBFC, right? So factoring means you sell invoice to factor at discount, factor collected, governed by Factoring Regulation Act 2011. Only RBI registered factors are allowed, and assignment must be filled with central registry. All are correct. Now let's look at the next question. This is regarding the PCFC, that is packing pre-shipment credit in foreign currency. So the question is regarding PCFC. Which of the following statement is correct? Option number A, PCFC is a short-term export finance facility normally granted for up to 180 days from the date of the advance. Option B, subject to export order validity, PCFC can be extended beyond 180 days up to 270 days with higher interest and regional office approval. C, in exceptional case, a further extension is permitted up to a maximum of 360 days. Beyond this, if unadjusted, the advance is repriced as a regular domestic loan. So very good question about PCFC. So what is the big picture here? That exporter need money before shipping goods. Why they need money? So they obviously exporter need money, to buy goods, right? They want to buy raw material. They want for possession, right? For processing. They need money for processing, for packing, right? So for all these things, the exporter need money, right? A bank, and bank, what bank do? Bank gives short-term loan, right? Bank gives short-term loan, and this short-term loan is given in foreign currency, and that is called PCFC, right? Packing credit foreign currency. That's the full form. See what is happening here, that before shipping the document, exporter need money for raw material, for processing, for packing, and bank finance this. Bank gives short loan for, that is called foreign currency, that is called PCFC. Now let's look at the normal tenor. So what is the normal tenor? Yes, it is usually given for up to 180 days, right? But this matches the exporter production and shipment cycle, and if needed, bank can extend PCFC up to 270 days. but this come from higher interest rate and regional office approval. Correct. So we can see that option A is correct and option B is also correct. What about C? Yes, in certain cases it can go up to 360 days. Beyond 360 days, if the export has not happened, the loan is converted into a regular domestic loan, right, at the normal rate. So all these three are correct. The correct answer is A, B and C. So this way you can remember. So PCFC initially 180, then 270 and finally 360. And beyond the 360, and you know this 360 is exceptional case. And beyond 360, it is just regular domestic loan. I hope this makes sense. Now friends, the next question pertains to DLG. That is called default loss guarantee. Default loss guarantee. Which of the statement is correct under the RBI guideline? So option they have given is DLG is a contractual agreement where a third party agree to reimburse a regulated lender for loan losses up to a pre-agreed percentage. B says RBI cap the total DLG cover at not more than 5% of the outstanding loan portfolio, and the guarantee must be portfolio level. Option C say DLG cover can only be provided in permitted form such as cash deposit, fixed deposit, bank guarantee in favor of the regulated entity. So what is the big picture here? The big picture is the DLG. DLG stands for sometimes this is also called FLDG. In the context of digital lending, if you see in the context of digital lending, we call it FLDG, but it's called DLG, right? So it is a way for the third party, often a fintech partner, to share some credit risk with the bank or NBFC. So using this technique, what happened? Some fintech partner, right? What they do, they share some credit risk. What is credit risk? I think you know it. So credit risk sharing is done by the fintech partner. With whom? With either the bank or NBFC. So using the DLG technique, fintech partner can share their credit risk with the bank or NBFC. In short, we can say that if the borrower don't pay, the third party cover part of the loss. So option number A, if you look at, option number A is correct. Yes, obviously it is a contractual agreement where a third party promised to reimburse loan loss up to a pre-agreed percentage of the defined loan portfolio. Option number A is correct. What about B? So bank gets some kinds of protection, right? So it is a contractual agreement where the third party promised to reimburse loan loss upon up to a pre-agreed percentage. What about regulatory cap? Yes, RBI say that DLG cover cannot exceed 5% of the outstanding loan portfolio. So cover cannot exceed 5%. Second point, it must be portfolio level, not loan by loan. Third point, there must be explicit legally enforceable contract. Correct. Option number B is also correct. What about option C? Permitted form and timeline. So DLG can only be given at the cash deposit, fixed deposit or bank guarantee in favor of the regulated entity. So DLG, this guarantee can be given as cash deposit, fixed deposit or bank guarantee in the favor of regulated entity. Suppose a loan get overdue, the guarantee must be invoked within 120 days. Once used, the amount cannot be reinstated. So option number A, B and C all are correct. So you can think of the DLG like this. You can think of, just wait a minute. Whenever you see this word DLG, just remember this word. Don't lose guarantee. Don't lose guarantee, right? So, and remember the three key numbers and word. The first is the 5% cap. Second is the portfolio level. Third is the 120 days to invoke. It takes 120 days to invoke. So remember, DLG is a third party cover first loss risk for a loan portfolio. Cap is 5% of the portfolio, must be backed by enforceable contract. Form can be cash, FD or bank guarantee, invoked within 120 days. I hope that makes sense. Now, have a look at one more question that is related to Altman Z-score, right? So regarding Altman Z-score, they have given X1, X2, X3, X4, X5. You know it very well, right? And this they have given you value of X1, X2, X3, X4, X5, and also. So friends, how to compute it? So option they have given. These are the options they have given. You have to compute the Z-score, and then you have to classify the borrower accordingly, right? So how to compute the Z-score? Let me explain it here. So here, there is X1, X2, X1, X2, X3, X4, X5. X1 is what? Net working capital upon total asset. X2 is what? Retained earning upon total asset, right? X3 is what? X3 is EBIT upon total asset. X4 is what? X4 is market value of equity upon long-term debt. X5 is sales upon total asset. Right? These are X1, X2, X3, X4, X5. Now, what value they have given, as you can see, they have given 0.10, 0.08, 0.12, 0.50, 1.20. Just put into the formula. What is the formula? Let me write down the formula. Z is equal to, the formula is Z is equal to 1.2 times X1, 1.4 times X2, 3.3 times X3, 0.6 times X4, 1.0 times X5. That is the formula. You just have to substitute the value, right? So that would be how much? 1.2 multiplied by 0.10, 1.4 multiplied by 0.08, 3.3 multiplied by 0.12, 0.6 multiplied by 0.5 plus 1.0 multiplied by 1.20. After computation, you will get 2.13, right? And one more thing I want to tell you, that what is the physical significance of this Z? So if the Z value is less than 1.81, it means risk is very high. And if it is larger than 2.99, then it is a safe zone. And between 1.81 to 2.99, it is called gray zone. The next question is, they have asked you that under RBI prudential norm for implementation of a viable resolution plan, that is called RP, what additional provisioning is required if the RP is not implemented within the prescribed timeline? Option A say that that if RP is not implemented within 180 days from the end of the review period, bank must make additional provisioning of 20% on the total outstanding. B say that if the RP is still not implemented within 365 days from the commencement of the review period, bank must make additional provisioning of 15%. Option C say that these provisions are over and above the existing provision held for the account. So what do you think? Option they have given A and C, B and C, A, B and C, A and C. So what do you think about the correct answer? What resolution plan under RBI, what additional provisioning is required? That's the question. Now friends, the big picture is that whenever the borrower is in trouble, bank prepare a resolution plan to revive the account, right? So what does whenever a borrower is in trouble, right? What happen? Bank prepare a resolution plan. The main purpose is to revive the account. RBI say that don't wait, don't delay, right? If you do, you pay extra provision. If you delay, you will pay extra provision. Why? To push bank for timely action. That's why extra provisioning has to be maintained as per RBI. So the first deadline is 180 days. If the RP is not implemented within 180 days from the end of the review period, so suppose the review period ended here. From the end of the review period 180 days, if the RP is not implemented, bank must make additional provisioning of 20% of the total outstanding. The provisioning to be done is 20%. Furthermore, if the RP is still not implemented within 365 days from the review period, right, the bank must make another 15% provisioning, that is 35% provisioning. So these extra provisioning are over and above the existing one, right? So now let's look at the option. Option A says that RP is not implemented within 180 days. The provisioning 20%. Correct. Yes, it is correct. What about B? If RP is still not implemented within 365 days, yes, 35%. Correct. What about C? These provisioning are over and above the existing provision held for the account. Correct. So the correct answer is A, B, and C. All are correct. So memory trick, I can tell you 180 degree, 20%, 365 degree, add 15%. Right. Total is how much? Total is 35%. Delay will cost you first 20 and then 15 more. This way you can remember it. Now friends, let's look at the next question. This question is regarding the pre-packaged insolvency resolution process. Which statement about PIRP for stressed MSME is correct? That is what they are asking you. Right. Option they have given that PIRP apply to MSME with default value up to 1 crore. And beyond this, IBC or other resolution mechanism apply. B says that PIRP follow the debtor in possession model, where the MSME approach creditor with a base resolution plan. Option C says that entire PIRP must be completed within 130 days of commencement and the resolution plan must be submitted. So which option do you think is correct? A and B, B and C, A, B and C, A and C. So basically, if you talk about the PIRP, it is a fast track insolvency process, right? So basically, that it is a fast track insolvency process, right, designed for MSME. It is quicker, it is less disruptive than the regular CIRP, right, less disruptive than the CIRP. Think of it like, MSME stays in control but work with creditor to resolve the stress. Now let's break down it. Option number A is all about, applicability. Yes, correct. It applied to MSME with default value up to 1 crore, correct. If the default is more than 1 crore, regular IBC or other resolution method will apply. So option number A is perfect. It is correct. What about B? Yes, B is also correct. It uses debtor in possession model, right? MSME itself approach creditor with a base resolution plan, right? This is MSME, and it is approaching the creditor, and they approach the creditor with the base resolution plan. And this is different from CIRP, which is creditor in control model. What about third? Yes, timeline. Entire PIRP must be completed within 120 days, right, of the commencement, and resolution plan must be submitted to NCLT within 90 days after COC approval, right? Within 90 days after COC approval, resolution plan must be submitted. Please remember it. So yes, it is a time-bound process. So obviously we can see here also A, B, and C all are correct. Option number 3 is correct. So just remember this word. PIRP is equal to 1 crore cap, right? MSME in control and 120-day clock, right? 1 crore MSME score, 120 day to close the door. I hope this makes sense. But listen first. 1 crore MSME score and 120 days to close the door, right? This rhyme you can remember it. Quick rhyme. Now friends, one numerical question let's do. Company detailed financial have been given. Like you can see, basically EBIT they have given 150 lakh. Interest expense they have given 60 lakh. And you have to compute the ISCR, that is interest service coverage ratio. And you have to classify the risk level. So have you heard this word ISCR? It may sound technical. So what is the big picture here? This ISCR tells us how easily company can pay its interest from its operating profit. Right? This ISCR tells us how easily a particular company can pay interest, right? Can pay interest from its operating profit, or we can call it EBIT. How quickly it can pay interest from EBIT. One more thing you may remember, that higher ISCR means more comfortable position. Lower ISCR means risky position. So what is the formula for ISCR? It is very simple. ISCR, let me write it down. So under numerator you write EBIT, whatever earning it is doing, and denominator you write the interest expense. Interest expense, right? Interest expense. That is the formula for ISCR. Now in this case, as you can see, EBIT they have given is 150 lakh. Interest expense they have given 60 lakh. So 150 upon 60 is 2.5, right? So ISCR is 2.5. And one thing you must remember, that EBIT upon interest expense, obviously the company might have borrowed, so it might have to pay interest, right? So whether EBIT is sufficient to pay the interest, that is what this ratio tells us. And you must know that, if ISCR is more than 2, it's quite comfortable. That means our earning is twice of the interest expense. And if it is, if it is between 1 to 1.5, so it means, it is tight, very tight. And if it is less than 1, it is very risky. And if it is 2.5, it is comfortable, extra comfortable. So 2 is the comfort gate. Above 2, you are safe. Below 1, you are in trouble. 1 is risky, 2 is comfy. This way you can remember it. Right. So what is the correct answer? ISCR is 2.5, just we have got, and it is quite comfortable. 1 number option is correct. So friends, if you want me to explain, we have more questions available. If you want me to explain those also, just write yes in the chat box. I will explain those questions also. And if you need PDF of such kind of content, where you get unit-wise theory, unit-wise MCQs, yeah, and in addition to that, you also get memory-based questions and capsule content. You can WhatsApp me on this particular number shown on the screen. This is the number, right? Or in the description section of the video, you will get the link. Do join our Telegram channel. Link is provided in the description section. In Telegram channel, you will get to know what are the important topics from your question have appeared, and also you can give some quizzes. Thank you.